Welcome to the Capital Compounder Show. This is episode number 8. Today we have a special guest. It's Jason Del Vicario. He's the portfolio manager at Hillside Wealth, which is a division of IA. Jason, glad to have you on the show. Welcome.
Thanks so much for having me. Glad to be here.
So the sweater. Tell us about the sweater if you can show us. So buy the effing dip.
Yeah,
Warren Buffett with
with
a
Uncle
Santa
Uncle
Claus hat.
Warren. Yeah, I
That
don't
is
know.
awesome.
It's just something fun. I think it was probably. I think my wife gave this to me in 2021 when the last time Bitcoin was sort of going a little bit crazy. So it's a little play on that. And you know, as a value investor, of course, Warren Buffett is. He's the man. And so I just wear this around Christmas time. It's good for a laugh.
He's the absolute man, and your wife's a keeper for buying that for you. That's awesome, by the way.
Yeah.
Um, so, Jason, like early beginnings, right? You have a degree in atmospheric sciences,
Hmm.
and now you're a portfolio manager, and you're celebrating your 10th year. Congratulations, by the way.
Thanks.
But how the heck do you go from atmospheric sciences to a CFA to portfolio manager? I would love to know.
So my tongue-in-cheek response is, if I was going to if I was going to be predicting something with not a lot of certainty. So I mean, weather modeling and predicting financial markets. I might as well get paid well to do it. But my story is a bit convoluted. My dad was an anesthesiologist, and I thought I wanted to go to medical school. I spent the first year at university realizing that I didn't want to go to medical school. And I've always been interested in the weather, and it never had even occurred to me that I could actually get a degree in meteorology. And so I switched gears after first year. And then after my second year, which was 7 out of my 10 courses were statistics, physics, or mathematics, I became a little bit sort of disenfranchised with meteorology because they were wanting to really uh, just make a science out of it. So, for example, we spent one semester studying the omega equation, which is a 10-term equation, of which two they didn't really know how to solve. So they were just a constant. One was, I don't know, whatever. And supercomputers were actually invented for meteorological calculations and purposes. In the meantime, they used to drop off a copy, the Financial Post, which was the National Post before the National Post became the National Post. They used to drop off stacks of this outside the Commerce Building, and I would pick up a copy, and I'd be sitting in the back of my cloud physics classes reading about the financial markets. My uncle also gave me The Wealthy Barber when I was 15, and that's when I discovered the what Einstein calls the eighth wonder of the world, which is compound interest. Money making money really appealed to me. So throw that all together. I started some investment clubs at university. It was also I was at university from 94 to 98. This was also when the internet kind of just went boom. And I had a friend of mine who was an electrical engineer, and he and I figured that all of this financial data now was now being made available. Before you had to like right away and get the annual report and read it. Now all this information was online. So we actually developed a piece of software that was essentially a robot that went on every day and fed us stocks that met the criteria that we were looking for, which is still kind of how we're managing and finding opportunities today. So really, it's just my passion. If I wasn't doing this as a job, I would be doing it with my own money. I love it. And so I guess I could say that I'm fortunate that, it went from med school to meteorology to now analyzing and managing money. And there's a lot of overlap. I mean, we bring a very scientific approach to the work that we do. We do all of our own work. And I'm sure we'll get into that. But that's sort of a brief overview of how I got to from there to here.
Absolutely. So you threw out those, those scientific formulas, and you said I'd rather study something like NPV, net present value, a lot more
Yeah,
utility
yeah.
there. And so you coded that interesting program that could pull
Hmm.
and compile data for you. But you've also used the Guru Focus API most recently
Yeah.
to build your own internal stock application, which we can obviously get into later.
Hmm.
Um, Super cool. So how did 2024 go for you? I know it's your 10th year.
Hmm.
Your focused growth portfolio model
Hmm.
is up, I believe, 32% year to date. And who
Yeah.
knows where it'll close? Maybe
Right.
it'll close higher, which would be awesome, obviously, for your clients.
Hmm.
But reflect on the year that's passed for us.
So it's interesting when you have a year like this. The natural tendency is to sort of ask about 2024. Well, 2024 has been great. Well, this year we've acquired three businesses and sold two. So we believe in running concentrated portfolios of of high quality businesses acquired at favorable prices and held for the long term. So really what we are experiencing in 2024, the table was set, the work was done really in 2022. So in 2022, the same focus 100% equity model that you're talking about, peak to trough was down about 25%. And that was an environment where my research partner, Stephen, and myself were very excited. We were on our front foot. We had done lots of work in 2020, 2021, and we were able to finally pull the trigger on some of these high quality businesses that we had had our eye on, or some of the high quality businesses that we already owned but didn't have quite a full position. So, quite frankly, what we've experienced in 2024 was really as a result of the work that we did, as recently as 2022, but really in 2021 and 2020. So, I mean, you can kind of liken our process. We have about 100 stocks in our investable universe. And these are stocks that we put through a very rigorous process. We read all the filings, we read the annual reports, we talk to management, we talk to anybody that we can, competitors, we'll research competition, et cetera, et cetera. Once it gets into our investable universe, that's sort of maybe a 1 in 100 or 2 in 100 in terms of the stocks that we analyze. It then needs to be at a price where we can expect a strong forward rate of return, a return over our hurdle rate. So we sit there and wait patiently for these companies to essentially usually go through some sort of short-term glitch. And then we'll recheck our notes. Is this in fact a short-term glitch? Like, for example, what we saw with Meta, or has the long-term intrinsic value of the business been frustrated? So that should give you a sense. So yeah, we're happy with the performance in 2024, but as a capital allocator, this is not a great environment for us because there are not a lot of these businesses that are now available at attractive prices where, we get that compounding. So,
In 2022, though, it was, and you bought the effing dip, right? Exactly what Warren Buffett would do.
Yes, we did. And it it is uncomfortable to do that. It is uncomfortable buying Meta at, I think, $98 was our most recent purchase. When the narrative, you turn on the news, so we really try and ignore the quote unquote narrative to the extent that we want to understand what it is, what the masses are thinking. But the narrative was that Meta was going to zero. People were leaving Facebook, people were leaving, blah, blah, blah. Zuckerberg had no idea what he was doing. He's wasting billions of dollars on this, nascent thing, the metaverse. What is the metaverse? Yet, we focused on the fact that half the world's population is on WhatsApp, Instagram, or Facebook. And they were, in fact, even adding users. Naysayers will say, well, these are bots and so on and so forth. Fine, whatever. All we know is that Meta probably has the biggest reach in terms of a customer base of any customer or any company ever. Maybe Coca-Cola is on the same level. And that's the moat. When you have 3.5 billion users, and you have 70,000 engineers, and you have a founder that's in charge of the business and can make decisions that professional managers or professional boards can't. We think that that's a very strong, basically competitive advantage, and that was offered to us on sale. So, yeah, we try and ignore the noise. It's difficult.
That's a smart buy, right? In 2022, yeah, it was almost impossible to pull the trigger on Facebook because, as you thought, most people were thinking, are they going out of business? What is Zuckerberg doing? Where is he allocating the capital? But he absolutely pulled the 180. That investment is probably up 3 times, I'd assume, right? 3 or 4 times since 2022.
Yeah, like six times actually.
6 times. Okay.
It's even more difficult because we owned it prior to that. So we went from 380 to 88 and back up to 610. And so there was a lot of checking our notes, checking our thesis. What are we missing? I think Meta has 60 analysts. So we have a really difficult time trying to determine where we have an edge. When we're looking at a company that is followed by 60 analysts, they're smart. So what was it that we were able to see that people weren't? And there's many examples like this. Games Workshop is a business that we own in the UK. There were a number of businesses that we were able to take advantage of sort of short-term dislocations in terms of the pricing compared to what we thought the businesses were worth.
That's an important lesson for investors, right? Because you can establish conviction at the initial purchase, but your conviction is tested again and again and
Yeah.
again.
Yeah.
And outperformance really is when you test the conviction, you say, this business, the underlying business is still fine, growing.
Mhm.
And then as you did, you're deploying more capital when there are short-term setbacks in the stock performance itself. So you mentioned that this year you sold two stocks. So
Mhm.
you sold like completely out of both positions.
Yeah. Yeah.
Um, can you talk about those two companies and why? It's just good to walk through the selling process that you have.
Sure. So, I mean, we made a mistake with a company by the name of, it's amazing. I've already forgotten it. Their brand is Fanatec. So they make sim racing, like steering wheels and so on and so forth. The mistake we made there is we got a little bit away from our discipline in terms of debt. We really don't like debt. This company had debt. Uh, Strong brand, market leader, founder run, founder owned, and it just they just blew up because of the debt. Essentially, the fact that we were able to sell it when it wasn't a complete 100% loss was amazing. The one thing that's interesting with our process, and so the mistake that we made there is that we went beyond our comfort level in terms of leverage, debt. I think that's always an important lesson for investors to learn, and maybe also an important lesson for less investors to learn, that maybe even people such as ourselves still continuously learn this lesson. There's a great quote out there that it's really difficult to go bankrupt without debt, right? So, this business had all sorts of challenges. Supply chain, right? There's chips in these things that they couldn't get during the pandemic when there was huge demand for their product. Then, when they finally could get them, they bought way too many chips. So it was a combination of poor management and leverage. Um, and what I was going to say is that we have conviction levels for everything. So we have our definition of high quality businesses, and then depending on the level of quality, our highest conviction level is 8%, followed by 5%, 3%, and 1%. So this was a 1% conviction level position. So because of the debt, because it was relatively small, because we had questions about the management, we it was a 0.5% position for us. So we like to part of our performance over the past 10 years has been when we're right in size. And when we've been wrong, we've generally been wrong small. Of course, we're not always going to be, that's not always going to be the case. But the other business that we sold is called Premier Anti-Aging, which is a business out of Japan. They produced a cleansing balm, so a makeup cleansing balm called Duo, which was the market leader, had a subscription model, which was really interesting. I mean, I'm obviously not a makeup aficionado, even though we do now own Estee Lauder, so we're becoming more more of aficionados in that industry. But essentially, we underestimated the power of that brand, the power of that product, and so the moat around that product, the sort of willingness for essentially Japanese women to pay a subscription fee for this product, we had misjudged that, and so that was I think we were down about 75% on that. Now, so these are two positions that we've sold in most scenarios. I mean, I just told you that we rode Meta down 80%, and we were adding to it and kept adding to it. And so why did we sell these two positions, yet we added to Games Workshop or we added to Meta? And that's really, I think, where maybe some of the art comes into the process. I mean, it's not, Stephen and I keep remarking to each other that this is maybe, and again, coming back to what I was talking about, atmospheric science, meteorology, anybody can say, anybody can realize that predicting the weather is not 100% science. If it was, they'd be right all the time. And everybody likes to joke about how they're not right all the time, right? So, you know, and so Stephen and I will say this to each other, like, if we have a business that's down 50%, if we're not willing to add to it, then to me, that's a sell. Like, if you don't have the conviction, if there's too many question marks, if there's too much uncertainty, to add to a position that is down 50% or 75%, probably tells you what you need to know, which is it's time to move on. And we are not active at all. I mean, as I said, high quality, favorable prices held for the long term. So we make little tweaks around the edges, but in general, we started 2024 with 29 businesses, and I believe we have 28 now. So the turnover has been very, very low, and maybe that's an indication that we're on the right track in terms of our assessment of quality.
And that 8% conviction level, is that a gradual buildup, or have you backed the truck up where there's so much conviction at the onset, your initial position you build is all the way up to the 8%?
That's a great question. So the only, well, you're not going to like this, but so we just downgraded Constellation from our highest conviction level to a moderate conviction level. So Constellation was our only 8% position. It's actually just shy of 15% of the portfolio. So we have discipline in terms of how large we'll let positions get. So the more common for us is a 5% position. We have I would say maybe around 8 to 10 5% positions. Typically, when we enter that position, we will enter it over, say, a 6-month period. It's rare that we'll take 5% right off the bat, because usually there's something going on with the company. So quality goes on sale rarely, and when quality's on sale, except for a 2008 type event, there's usually something going on with the business. They've missed earnings. I don't know. They've allocated they've done maybe a bad acquisition. They've allocated capital poorly. Maybe there's like Meta, there's sort of some outsized noise going on that everybody believes that the business is poor, or whatever the case may be. And so it's usually, like, for example, we've just recently bought Estee Lauder. We've also recently bought, so the ones that we've bought this year are Paycom. These stocks are down 70%, 80% from their highs. And so we like to scale in, because when a stock's down 50%, it could be down 60, 70, 80. And of course, as the price of a security that is a high predictable business goes down, the forward rate of return goes up. So we like to scale in, and we like to see it go down further. As uncomfortable it is as it is, that's typically how we'll behave.
And so you mentioned Paycom, you mentioned Estee Lauder. Is there a third company that you bought into? Maybe I missed it this year.
Yes, it's called Activation Group. It's a very small business based in Shanghai, traded on the Hong Kong Exchange. They're an experiential marketing company for luxury brands. So their customers will be LVMH, Hermes, Estee Lauder, and so they'll market luxury to the Chinese consumer. And unsurprisingly, that business has suffered a little bit, because the Chinese consumer isn't sort of as willing to part with their money as they were a number of years ago. They've got issues in China in terms of a real estate bubble, and the economy is a little bit sluggish. But I think we were paying about 6 times earnings for this business. It has around a 10 to 12% dividend yield. We've met with management. It's founder run, founder owned. They have no debt. In fact, I think 75% of their market cap is cash. But it is in China. It is a relatively small company, and so it's sized accordingly. It's a 1% position for us.
But then all these 3 purchases you made in 2024 have something in common, and it's that they're facing short-term setbacks, right?
Mm-hmm.
And those setbacks are reflected in their stock price performance. So it's you being able to buy in at obviously a lower price, and hopefully there is a re-rating over time, right, of the stock itself.
Mm-hmm. And so, I mean, Estee Lauder, we've been studying them for a while. Paycom was one that I picked up on, and I said, hey, we should look at this. This looks like a reasonable company that's down 75%. So it was the fact that it was down that was the impetus for us to study it. But with Estee Lauder, it was already a company we were familiar with. Same with Activation Group. This is a company that we're familiar with. We do nothing in a rush. So, I would say it takes us a good month to 2 months before we become comfortable with a position.
That's awesome. Didn't Estee Lauder years ago buy MAC Cosmetics, the Canadian company?
Yes.
I believe so, right? It's in their brand portfolio. So have you ever met the co-founder? If you're ever in Toronto, there's a restaurant, and I think he's built 2 or 3 now. It's called Impact Kitchen.
Okay.
Check out Impact Kitchen, and sure enough, you might meet the co-founder of Mac Cosmetics there, because he's basically the founder of this restaurant, and he pops around each of the locations in downtown Toronto.
So
If you come
this
to
is a
visit, Jason, we can go. Yeah.
sounds great. This is a rare day in Vancouver. It's sunny, so I'm just going to close the
Okay.
blinds next to me here
Sounds good.
because I'm about to get slammed with
And
rare,
and and,
rare
and
West
there's
Coast
something else
December
about you
sun.
as well, Jason, that most people might not know, is that you're not scared to venture out of North America,
No.
right? You're absolutely not. If someone were to look at your portfolio, they would say, okay, so Jason's ventured into Europe and China, the stock that you sold this year, Japan. So tell me about that evolution. Like 10 years ago, were you comfortable investing outside of North America, or did that come with time?
Yeah, so that came with the it's difficult to sort of chicken and egg that type of analysis. So we bought our first foreign security in 2020. We're now approximately, we have three securities in Canada, so Constellation, Couche-Tard, and Bioscience. We have about a half dozen in the States. So between Canada and the States, I think we're around 50%. But the bulk of our positions in terms of numbers are outside of North America, and around 50% of the portfolio is outside of North America. Now, the reason is because that's where, Charlie Munger, fish where the fish are. That's where the fish are right now in terms of valuations. So North America doesn't have a monopoly on high quality businesses. There's many high quality businesses across the world. Does the United States have the bulk? Yes, I would say so. But they're not available at prices that make sense to us at this time. We'd love to own Rollins, for example, the pest control company. We'd love to own Monster Beverage. There's a number of high quality. We'd love to own Old Dominion, NVR. I mean, a lot. We've studied a lot of great businesses in the States that are on our list. And if the price falls 40, 50, 60%, we would be thrilled to own those businesses. But in the meantime, to be able to generate the returns above our hurdle rate, we've needed to look outside of our borders. And it's been really interesting. I mean, I would say that the sort of just loosely the three areas of the world that I think offer sort of some compelling businesses that are of high quality and also available at prices that make sense would be the UK. And I think that opportunity has been there really since the whole Brexit scenario and still available. Hong Kong. Hong Kong is really interesting. Actually, the UK and Hong Kong, as a Canadian investor, the dividends are not subject to withholding tax. So that's an interesting little tidbit. I mean,
Hmm.
that's not why we're there, but just something to add. And then Japan. Japan is amazing and frustrating at the same time. There's lots of really wonderful businesses there, but the capital allocation in Japan leaves a lot to be desired.
They're not as shareholder friendly, are they? Or shareholder driven in Japan?
They're not. It's society first, employees, customers, shareholders. Like we're at the bottom of the list. So Stephen and I actually went to Shanghai, Hong Kong, and Tokyo
And
last
for
March.
viewers, Stephen is your associate who recently
That's right.
onboarded.
Yeah,
Okay.
yeah. The two of us are at this together, and I'd never been to Japan. Stephen's from Shanghai, so obviously he's familiar with Asia. And Japan is, I mean, it's an amazing country. It's clean, it's orderly, it's if you love food, I love Japanese food. The food's amazing. The people are polite. It all just sort of, I mean, you've got 30 million people in Greater Tokyo, I think, and
Yeah.
it doesn't seem crowded or busy or suffocating or in any way. It's just all really, really well organized. Um, and we've started to learn a lot about Japanese culture because when we speak with all the companies that we are invested in, so when we speak with them, we're using an interpreter. And many times the interpreter is somebody who's lived in Japan or is Japanese Canadian. And so we can kind of speak with them before or after the call and say, here's what we're picking up on. So, for example, what we've picked up on, if you look at any investment relations documents from Japanese companies, they almost all look the same. They talk all very, very similarly. And what we've learned, this is super interesting. We just learned this like 2 weeks ago. I mean, we've been looking at Japanese companies for years now. 2 weeks ago is that after the Second World War, and so one of the interpreters we had was from Hiroshima, and he said, and so I said, like, help me understand, why do they all say we got to add a new pillar or new pillars, Or why do they all look like they want to become the next SoftBank? So they're going to set up like a venture capital arm, completely unrelated to the business that they're doing. Like, why won't they just return the money to shareholders? So what he said was really interesting, that after the Second World War, Japan was American occupied, and the Americans um, were in charge. Well, so the Americans occupied Japan, and one of the ways that they thought that they could get Japanese people to comply and to not rebel was in the education system to get children to be very, very homogeneous and similar. And so, the nail that sticks out, gets hammered down. And even though that this was a sort of a philosophy and an educational philosophy brought by an occupier, it still has translated into Japanese culture decades later, in that they are sort of society first, and comply. Don't do anything too differently. So we're always on the lookout. I think I've mentioned this book to you in the past, called The Outsiders by William Thorndike. Have you
Fabulous.
read it?
Wonderful book.
Amazing book,
Everyone
right?
should read the book. Yep.
So we are hunting feverishly, and
Yep.
it's tough to find the outsider of Japan, or the Warren Buffett of Japan. And it's really, really tricky to do, because at a societal level,
Yep.
they've had it conditioned in their heads to not stand out,
Yep.
to not do anything that's unusual.
Don't go
Um,
outside, right? Don't
yeah,
don't go exactly.
yeah, yeah. And so, and then similarly, so our complaints about capital allocation in Japan is, either they'll set up, venture capital arms, or they'll start these second and third pillars. Hopefully it's an adjacent activity, so a business that's related to what they're doing, but oftentimes it's not. Like, you look at the Seven and I issue that's going on, well, Seven and I scenario that's going
Yes.
on with Couche-Tard, and
Yes.
Seven and I has convenience stores, banks,
Yep.
lending companies. They're delivering luggage to airports. I mean, they're doing all sorts of different things, and but one of the things that they'll do is pile cash up on the balance sheet. And if you're looking for companies to produce consistently high returns on equity, as the cash builds up, all things being equal, the returns start to fall. And again, this is another thing that has came out of the Second World War. You can imagine Japan completely decimated, sort of like the Greatest Generation, which was my grandparents who grew up during the Depression, always buying with cash, couldn't understand, us boomers, or the boomers, or Gen Xers running around with credit cards. Oh my God, this is madness. It's the same type of philosophy in Japan. It's that they squirrel away and they build up cash, because they've had the experience of having nothing. Um, and so it's exciting and challenging. Like, studying companies in Japan is a combination of excitement and challenge.
Yeah, and so you haven't found that one outsider company yet. You're still in the
Well,
pursuit.
so we own two.
Okay.
We own kakaku.com, which is not really founder run, founder owned, but they're probably as outsider as it gets in Japan. This is like amazing for Japanese companies. They have an ROE target of
Oh,
40%,
wonderful.
which is amazing.
Wonderful. 40%.
40%. And they
Wow.
do it. They pay a dividend, they buy back shares opportunistically. Um, I won't say that they focus on their core business, because they actually have three core businesses, and they are a bit of a spawner. So they're an internet-based business. They have a price comparison site, which is the name of the company, kakaku.com. They are kind of the Yelp of Japan, the leading restaurant review site called Tabelog. They also have a jobs classified business now. And so they have a history of spawning these internet businesses, which of course are capital light, high margins, high predictability, a lot of recurring revenues. So I would say that is probably the business that might fit to be the closest. But they're now starting talking about M&A, which always worries us.
Hmm.
So they've had a new change in management. So we'll see how that goes. But that's a fairly large position for us.
And if we hone in again on Alimentation Couche-Tard, which is one of
Mhm.
your, as you said, three Canadian holdings,
Yes.
um, what's your opinion on their relentless pursuit of 7i, which is 7-Eleven?
Yeah. Um, Honestly, this feels like a vanity project for Alain Bouchard. If I'm being completely honest, it so he tried in '05. I think he also tried in 2020. I admire his tenacity. I admire his desire to be number one. So Couche-Tard is the number two convenience store player in the world, and 7-Eleven is number one. Um, the way the Japanese have responded doesn't surprise me at
Yeah.
all.
Yeah.
Doesn't shock me at all. I suspect they are not happy about this. But frankly, they should be looking at themselves in the mirror in terms of how. I mean, if you pull up a stock price of 7 & I Holdings and compare it to Couche-Tard, or pull up the return on capital over the last 20 years and compare, like, it's not even close.
No.
And so if Couche-Tard, this is interesting. If Couche-Tard just does what they do, which is continue to be excellent operators and excellent deployers of capital, not buying $50 billion companies, but buying 200 million, 500 million when these convenience stores, because the industry is still very fragmented. If they just continue to do what they do, they will be number one. I just don't know if they'll be number one in Alain Bouchard's life. And so I worry a little bit about this being a sort of a legacy or a vanity project. I have no concerns that they would be able to take the convenience store operations of 7-Eleven and 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 do well with it. I have concerns with them cutting a check for $50 billion,
Yeah.
because your margin, you buy 200 convenience stores in Georgia or Tennessee and it doesn't work out well, fine. But I mean, Couche-Tard itself is a $70 billion company, right? So, and they're, they'll have to take on debt, they'll have to issue shares. So, I know a lot of shareholders are excited about it, but we frankly kind of wish that it doesn't go through. And I reading the tea leaves here, I don't see it
Mhm.
happening. If the founding family takes 7-Eleven private at $60 billion, my guess is Couche-Tard will have the opportunity to buy it for less than what they've bid in 5 years or 10 years, because they simply haven't done a great job managing the business. Just look at, for example, so 7-Eleven bought Speedway, which was a chain of convenience stores in the States, for $12 billion. In the price that Couche-Tard is offering them, I think that's probably worth around $5 billion. So this is a classic example of a unsexy business, right? Convenience stores, nothing sexy there, where you have one operator that has a capital allocation framework where they are disciplined, they have a hurdle rate, and they will only buy when the price is at or below the price they're willing to pay.
Mm-hmm.
By the way, is how we allocate capital, versus a company who is willing to pay any price. So it was Couche-Tard and 7-Eleven were bidding against each other for that Speedway. And Couche-Tard said, no, we're out.
Yeah.
You guys
Yeah.
go crazy, overpay for this. That's fine. We're out. I just worry that they don't necessarily seem to have the same discipline of backing away. Although they only increased their offer once, they haven't done anything since.
Mm-hmm.
So I don't know. We'll see. Our hope is that it doesn't go through. I
Got
think
it.
there's
But, but
plenty
but
of opportunity for them to keep doing what they're doing and be very effective at that.
but as you said, 7i, it's likely they could privatize, but then that could be the fourth run that Alimentation takes, and that could be it.
Mhm.
So Constellation Software, another holding,
Mhm.
Canadian holding of yours. I
Yeah.
know when we met last, this might be controversial for some people who are, just believers in Constellation and everything that Constellation Software touches.
Mhm.
Um, as did all shareholders, you received shares as a result of the spin-offs of
Yeah.
Topicus and Lumine.
Yes. Yes.
But you decided to then sell out completely of your positions in Topicus and Lumen. So
Mhm.
why sell out?
So Constellation was our number one position in 2014, and it remains number one today. Meta's
So day one, Constellation
day
was
one day
number one.
one
So
Constellation. Yeah.
Jason, why? Like, how did you stumble upon Constellation like 10 years ago? Quite a few people I talked to,
Yeah.
they only stumbled upon them during the pandemic, but this is 10 years ago.
You're gonna hear a you're gonna make me cry, because I didn't stumble on them 10 years ago. I stumbled upon them in like, well, I
Oh,
remember the price. They were $70. Okay, $70, and I didn't know what I know today. Had I known what I knew now, then I would have been backing up the truck at $70. I mean, because if you look at the financials of Constellation Software all the way back to when they went public in '06. By the way, this is another interesting thing that some people don't know, is that Constellation, when they went public, the only reason they went public was to give a liquidity event for a private equity holder. Mark Leonard had never wanted to take the company public. He only took it public to let the 50% holder cash out. In fact, when Constellation went public in '06, they didn't rate that. None of that capital came to the company. So they only ever raised money once, which I think was in 1996, which was $25 million. So he's turned that original investment of $25 million into, I think we're pushing $100 billion today, which is amazing. So thank you, short-term private equity, for giving us Constellation Software. And we've also seen this happen in a few other scenarios in businesses that we've taken in positions, because all the businesses that we own produce profits. And so often we'll ask these founders, like, why did you even go public? Why would you? I mean, all of the annoyances of being a public company, the audits, the accounting, the SEC, blah, blah, blah. Like, being a public company, if you have the option to be private, you should stay private. So we hear things about prestige or private equity wanted out. So we are forever thankful to private equity. And I also say tongue in cheek that we own the best private equity company in the world. So we get asked a lot, do you own private debt? Do you own private credit? Do you own private equity? Yeah, we do. And we own the best private equity company in the world, Constellation Software. They've acquired 1,000 businesses, private businesses, and the founder works for $1. That's his salary. And so the incentives are beautiful at this private equity firm. So, what was the question? Why did we sell Lumine and Topicus?
Well, like before that,
Or how did we come
2014,
across them in
finally
the first
pulling the
place? Right,
trigger.
right.
I know you wanted to pull it
Yeah.
at 70, but 20, hindsight's
Right.
2020.
Yeah.
But it's
So
still a lot of people in 2014 thought, wow, like they went to the website of Constellation Software and thought, was this a grade 10 student who, programmed the website? What's going on here? It looks a little primitive, right?
yeah,
So
we like that.
walk me through the decision-making process to finally say, we're going to allocate capital in year one
Right.
of your operation.
Right. So I had been following Constellation for a long time. I'd been reading Mark Leonard's President's Letters. Anybody who's watching this, it's must read. He doesn't write them anymore. He writes very sporadically, but all of the old President's Letters are there. I mean, same obviously goes for Warren Buffett at Berkshire Hathaway. Total side note, my dad, who's almost 80, tells me today he wants to do his CFA. And I was like, okay. And he's like, I've got time and I'm interested. I said, okay, don't do the CFA. Just go to Berkshire Hathaway's website and Constellation's website and read all of the letters there, and then come back to me. And if you're still interested, I'll give you more stuff to read. But you'll learn more there than taking your CFA or MBA. And so he liked that, because, of course, that was the free option as opposed to doing a CFA, which is like $800 a year. Okay, so where to start with Constellation Software? So first of all, acquiring VMS businesses. So they're acquiring mission critical software businesses. So if you're running a sports club, you need the software to organize your members and court bookings. And so it's this kind of software where you have high stickiness, meaning the customers are quite sticky, like 95% retention or what have you. So you're acquiring businesses that have recurring revenue. So usually it's like some sort of subscription, you're paying monthly. The customers need your product. The product as a percentage of your overall operating costs is relatively low. So if somebody comes to you and says, hey, listen, I'm going to give you better club management software, it's going to cost you $200 a month instead of $300. Are you really going to switch? So there's switching costs issues there. So we liked the focus on those types of businesses. We also understand, per Mark's sort of original assessment of the TAM, was that there was maybe 40,000 businesses that they've identified across the planet that fit these characteristics, meaning that they're a leader, that they've been run well, and they're available at prices that make sense. So the average, still to this day, the average acquisition of Constellation is in the $3 to $4 million range. So they're not bidding against private equity. They're not bidding against anybody. The other thing that's really interesting about Constellation Software is they've now done 1,000 of these acquisitions. I think when we bought them in 2014, they were at maybe a few hundred or what have you. It's if you think about the person who responds to the overtures from Constellation versus the overtures from private equity. So Constellation says, hey, we're not going to give you the best price, but what we can promise you is that we're going to keep your employees, we're going to keep the product, and we're going to keep your customers, and we're going to hold you forever. They've sold one. Mark Leonard says, my only regret is I'm selling that one company. So they've acquired 1,000 and sold one. They've kept 999. So if you care about your product, your customers, and your employees, and you're okay not taking the best price, then you're going to go with Constellation, not the private equity person who is just going to dress it up, put a little lipstick on the pig, and flip it in 3 years or 5 years, right? And so now you have this constellation of founders who have chosen to take less money and partner with a company that is doing things for the right reasons. And I think that's a hugely powerful part of their competitive edge and moat that, of course, is very difficult to replicate because they've got such a lot of people have tried copying Constellation, but it's difficult to replicate that type of discipline. So I just understood the business better, and I'll admit it, it took me time. I like to think Stephen and I always say to each other, listen, we are on the hunt. Like, we are relentlessly on the hunt to find the next Constellation Software. I like to think that if the next Constellation Software, smacks me over the head, it'll take me, quicker than 5 years to realize it. But it took us some time. It's another interesting exercise, right? So they went public at $20 in 2006. We bought them in 2014. I think they were around $250 or something like that. A lot of people will say, oh my God, like, the stock is up 12 times. Are you crazy? Like, why are you buying this company? And it's at $250. Net, they've never split the stock. I don't understand it. Mark Leonard doesn't do any interviews. He doesn't do any analyst calls. Like, it's a black box. And so I think it's an interesting exercise that once you find a high quality business that has shown the ability to compound capital at elevated rates, in Constellation's case, greater than 30%, which is really almost unheard of.
Yeah.
As long as you're not paying 50, 60, 70, 80 times earnings, which I think might be your next question, that's okay, right? And it didn't scare us or bother us that the stock was up 12 times from the IPO price when
Yeah,
we finally entered the position.
because since you entered the position, it was years later.
Mm-hmm.
People thought you're crazy to do it,
Mm-hmm.
but from the 250 mark to now, it's the price per share is heading to 5,000. You're looking at 20x in your initial investment. So
Right.
the question people might be asking now is, is this overvalued? I know it's not as high conviction as it was, but I'm curious. Did it pop up in a screen? I know that you use
Yes.
Guru Focus. So how did you screen it? Was it just return on equity? You thought, okay, this is a high return on equity company. I've got to dig.
Oh man, I wish I could remember that. So this was before I had the Guru Focus subscription. I was probably using Google or Morningstar. I think even Yahoo used to have a screener. Back in the day, I was screening more for earnings growth than necessarily the focus on return on capital. So that shift in terms of understanding that it's really the return on capital and the consistency of that return that really drives the business forward, not necessarily the earnings growth. Some people might not quite understand that. If you have to spend a lot of money to push the needle, that earnings growth is much less meaningful than if you have to spend less money. So, that speaks to essentially the efficient use of capital and capital light business operations, which we really favor, and that's something that we look at. But it's so that's quantitatively. Qualitatively, if you read the annual report of Games Workshop, if you read the writings of Mark Leonard or Warren Buffett, you start to, and if you come across enough high quality leaders and enough high quality culture, you can really start to understand the commonalities that exist. And again, coming back to that Outsiders book, that's really what he focuses on. Here's 8 amazing people that have compounded capital at an elevated rate for a long period of time. What makes them tick? What are the similarities? So from that book, for example, many of them, I believe, were electrical engineers. Many of them never talked to the media. So when we write to companies and say, hey, listen, We're a wealth management company in Vancouver. We've come across your company with interest. We'd love to chat with you. When they tell us no or get lost, which isn't often, that to us is a green flag. That's like, oh, really cool, good. That means they're focused on the business.
Yeah, they're not promotional. They're
They're
just focused
not
on the business.
promotional. Yeah. So, when Mark Leonard talked about, so I think you've gone to one of the AGMs, right? As of high,
Hmm.
he's 6'7", like 300 pounds or whatever, right? He flies coach, and he talks about this in his president's letters. I have the wealth to be able to fly business class, but I fly coach because there's many people that are flying around the world on behalf of Constellation looking for businesses. And what does it say to them if I'm sitting at the front of the plane, drinking champagne and eating caviar, right?
That's an amazing attitude for someone as wealthy as Mark Leonard
Well,
has
and same
become.
with
It's just to maintain that discipline and philosophy is just phenomenal.
And same with
Yeah,
Buffett and Munger have lived
yeah,
that their entire lives. Buffett, I've been to Omaha. He lives in the same house that he bought in 1950 or 30 or whatever it is. He drives a Cadillac. Uh, he's not a flashy guy, and so it's interesting because when I first started, I was screening. I was very much kind of a quant based type of investor, and I'll credit Stephen for this. And you can't you can't understand the culture of a business by only reading filings or annual reports or listening to analyst calls. You need to really dig deeper. You need to talk to them. You need to look at the whites in their eyes.
yeah.
And it's interesting because I'll give you an example. In Hong Kong, we own a few businesses. One of them is called Cato, and they are a elderly care facility. And when we went to Hong Kong to meet with them, we met in one of the exercise rooms of one of their elderly care facilities because they don't have a head office. This is unheard of. This is like $100-200 million business. They don't have a head office. Why? Because it's in the founder's view, it's an unnecessary expense. I mean, that might be taking it to the extreme, but I was like, wow, like these are the types of people we want to partner with. Another one of the businesses in Hong Kong, when we went up to meet with them, we went up the freight elevator, literally the freight elevator in their building, because there was no there. That's what it was. It was a commercial space. There was no lobby. There was no secretary, and the founder said, "Oh, we'll go into one of these little boardrooms here, but that's my desk." And it was like there was probably a room with 200 people in it, and his desk was just sitting right in the middle of the place. I mean, and Stephen and I are kind of like that. Like I am sitting in an office here. There's three of us. The head of Hillside Wealth sits in an office with two other people. I don't have my own office, and it's that type of sort of just kind of humble carrying on with your business. What we do here at Hillside, we're trying to increase the wealth of our clients. Anything that is outside of that is noise to us. I don't need a corner office. I don't need a fancy office. And
Yeah.
what we found is we've kind of attracted those types of businesses in our portfolio, and it's fascinating. So the culture at Constellation is really what I think drives the business forward, and it's really interesting. So we spoke. I have a high school friend that worked at Constellation, and
Oh.
Stephen and I just had a chat with him a few months ago,
Hmm.
and just talking about the incentives, right? My favorite quote in the world is Charlie Munger's quote, which is "Show me the incentives and I'll show you the outcome." And what
Yeah.
we really wanted to understand is how do the incentives drive the behavior at Constellation? And how do they continue to keep executing at such a high level and generating these returns on invested capital? And what they've done, and what Mark Leonard has successfully done, is he has downloaded the duty of allocating capital from not only the operating groups, so Valeris, Harris, et cetera, but then to the next level and the next level and the next level, such that even people that they've bought their business for $3 million, who maybe they stay on for a few years, they even have the ability. Of course, there's guidelines and framework. Not only that they have the ability, but they also have the incentive to
Mhm.
go out and try and make really sensible, value accretive acquisitions. Um, their management bonus it should be famous. It's not famous, but it should be, right? So 3/4 of the after-tax value of their management's bonuses must be used to buy shares on the open market. Constellation has never issued a single share beyond their IPO. So
That
again,
is
I'm just
phenomenal.
throwing
That's
these things out there.
1%,
But
right?
when
Yeah.
you add all of these factors
Yep.
together, to me, it jumps off the page and screams high quality. And that's the type of business that we want to own. And it's the type of business that we continue to own. Now, I will say, for full disclosure, we have trimmed a little bit. So we sold 5% of our Constellation position. We do have a discipline on the, so selling is always easily the most difficult part of this business. But we will sell when a position becomes greater than a factor of our original conviction weight, or greater than a factor of our original fair value estimate. So for Constellation, it has started to become a little bit expensive. This is something that Stephen and I will go back and forth on, shall we say politely. He's always wanting me to assign a multiple based on last year's earnings, like not this year's earnings, last year's earnings. Whereas
Interesting.
many portfolio managers I talk to, they'll say, well, no, Constellation's not cheap. They're trading at 33 times next year's
Yeah.
earnings.
Future. Yeah.
And so Stephen and I will argue a little bit about this, because I think a company that has shown the ability to grow at 20-25% year in, year out, they grew in '08, might at least deserve to be valued on this year's earnings. Okay, fine. Next year, I can get that. But we're really conservative in our work. We're always basing it on last year's earnings. And so we've trimmed them a little bit. But yeah, it's just a fabulous company.
And so why sell out 100% of your positions in the two spinoffs from Constellation?
Right. So, um, so a number of reasons. Number one, Constellation owns 60% of Topicus and Lumine, I believe. So we knew that by owning Constellation, we would still have exposure to Topicus and Lumine, even if we didn't own them directly. From a simplicity standpoint, we felt confident in our ability to continue to have the bandwidth to understand Constellation, excuse me, and analyze the business. Number three, we think that they're going to keep doing this. So this will become a bigger analytical problem for us if it was Constellation, then Topicus, then Lumine, then X, then Y, then Z. And then lastly, if we think that Constellation will continue to do spin-offs, you will benefit most if you're a Constellation holder than necessarily a Lumine or Topicus holder. Now, you and I could probably say, well, maybe Topicus does a spin-off at some point. Yeah, I don't know. So I don't know. Those were our reasons. My kids still own Lumine and Topicus in their RESP, so I haven't actually sold them in the RESP. But yeah, so I would guess a combination of simplicity, the fact that we would have the interest already through Constellation, and thirdly, we think that by having more exposure to Constellation, that we probably put ourselves in a position to enjoy more spin-offs in the future. And I guess we would probably do the same thing, meaning once there's a spin-off in the future, we would probably sell that and just put the proceeds back into Constellation.
So if we move on now to 2025, which is fast approaching, what's your general sentiment, Jason, for the year ahead in the U.S.? Let's talk about Canada, and let's talk about abroad as well.
Now you're sounding like BNN. Um,
Oh no. Okay, maybe.
I say that tongue in cheek.
Yeah.
We got out of the prediction business a long time ago. I mean, what I will say is that, um, over the long term, you want to be an owner of equities. Um, Owning businesses as opposed to lending money to businesses has proven to be a wonderful wealth creator over the long term. Um, we don't make short term predictions. We think that the 27 or 28 businesses that we own right now are great and will continue to increase their intrinsic value, which should increase the returns for our clients. Of course, there's going to be periods of times where the markets trade meaningfully above the intrinsic value and below. If you had asked me this last year, I would have said, we're probably facing some valuation headwinds because things were a little pricey then. I mean, they're pricier now. We've had the best year we've ever had this year, and I would have been completely wrong. So whatever I'm going to say in terms of what I think is going to happen in 2025 is probably going to be wrong. We just think that people who have greater than a 5-year time horizon should have primarily all of their investable assets in a concentrated portfolio of high quality businesses. In terms of our behavior and our activity, it doesn't change. I think we've got 3 or 4 calls with Japanese companies this week. We are relentlessly looking for businesses that we can either put in the stable of our investment universe, or the odd unicorn that is high quality and trading at a favorable price, how we would fit that into portfolio. So we're always constantly increasing the quality. So we have a few businesses that we own that we know we would sell if we found something better. And so,
And that's
you know,
the reason why I asked, because you're seeing different valuations globally.
mhm,
So I wonder if you have a bench in Canada, because you only have 3 holdings in Canada currently.
yes,
Is there a bench? Do you have candidates
no,
that, no?
no.
Interesting.
We, so dollar, so if we want to talk about mistakes, so we sold Dollarama at like $68. It's now at 140 or something like that. We probably either shouldn't have sold it, or we should have scaled the position down. We should have downgraded the conviction level from say 5% to 3%. The reason that we sold, or that we became less enamored with Dollarama, was because they were borrowing to buy back shares. And that sort of financial engineering scares us a bit. I mean, we were talking about debt earlier. Now, can Dollarama afford the debt? I mean, they survived the pandemic. They were named an essential service they survived 2008. They were named an essential service during the pandemic. I made a impassioned argument that this was a business that, and when there is economic uncertainty or weakness, people flock to Dollarama. So there's even a sort of a bit of a counter cyclicality there. But we made the decision that we were concerned about the debt. So if Dollarama got to 15 times earnings, and let's say their debt to EBITDA was less than 2, we would probably own them. But there's not much else in Canada that I mean, look, the Canadian marketplace is dominated by financials, materials, energy. These are typically not areas that are strong and have a history of sort of being founder-led companies that have consistently generated strong returns on invested capital. So we don't have a lot. I mean, we look at everything. I mean, we are essentially screening developed nations across the world constantly, and we would love nothing more for a Canadian company to drop through our screen for us to study further. I think on our Richards, Richards Packaging, they're on our
Yeah.
to-do list.
Based out of Mississauga, right?
Right. So
Richards.
that's a business we may have a look at. Their returns are in the kind of high teens range. We're really looking for over 20%. But that's one that's on our to-do list. So I don't know if that answers your question.
It does. If we're to look at, I know you're not in the prediction business because anything can happen, but 2025, if we can hear your top 5 best ideas for
Ooh,
2025.
okay.
Yeah. Highest conviction going into the new year.
Okay. So whenever I'm asked to give top picks or these sorts of ideas, okay, they will always be positions that we own. Number one, I don't see the point of going on BNN or something like this and talking about something we don't own. We'll get that out
Of
of the
course,
way
full
right away.
disclosure, you own everything.
And
Yeah.
I'm going to give you the positions that we own that are most favorably priced, meaning that they're the lowest
Mm.
valuation, and ones that we're probably adding to right now. So, Fever Tree in the UK. This is a 3% position for us. We've added to it recently. They've experienced a bunch of short-term issues in terms of glass prices, shipping prices. They produce a premium. Well, they actually created the premium mixer market. Their
It's
slogan
a
is,
delicious drink, by the way. They're basically in every grocery store in Canada now, aren't they?
yeah. So they say
Yeah.
if 3/4 of the drink is the mixer, mixed with the best. So they went. The founders went to Africa and sourced quinine, and I mean, if you put the Fever Tree tonic water versus the Schweppes tonic water, you notice the difference. It is a
Oh, yeah.
higher quality product. It also
Yeah.
looks nice because it's in a bottle and so on and so forth. And they've done this with ginger beer and margarita mixes and so on and so forth. What's really also interesting, so when we first invested in them, we're like, like, are gin and tonics going to be a thing, right? Because it seems to be mixed drinks. It's gin and tonic one year, then it's rum and coke the next year, and what have you. What's really interesting with Fever Tree, and I've done this myself, is you can enjoy the tonic water or the ginger beer without any alcohol in it. And
Yep.
younger people today are drinking alcohol less. And so we
Yep.
think that whether it's being mixed with alcohol or not with alcohol, that they've really created an interesting niche. They are number one in every market that they're in, except for Germany. So one of the big things you'll hear from us is that we want to invest in winners. So we're not in the business of predicting winners. We want to invest in
Mm.
companies that have already shown demonstrably that they are the leaders in their space. Fever Tree is without question the market leader. In the UK, Fever Tree Tonic outsells Schweppes Tonic. And so if they're able to replicate the success that they've experienced in their home market in the UK elsewhere, by the way, the US has now become their number one market. It'll be a fabulous business. Stock price is down 75, 80%. You kind of have to plug your nose a little bit buying. But we think, over the next 10, 20 years that long-term minded investors will be incredibly well rewarded. Evolution
I can
Gaming.
attest. It's an amazing product. I've had the non-alcoholic version. It's just great, high
Yeah.
quality.
Yeah.
Yep.
Evolution Gaming out of Sweden is a very interesting business at a very nice price right now, trading at 15 times earnings. I think their dividend yields around 3%. This is a business that is consistently growing at 20%. They have 75% EBITDA margins. It's one of the most profitable
Wow.
businesses we've ever come across. They are also the number one casino in the world, and I guarantee you've never heard of them. The reason you've never
Nope.
heard of them is because they dominate live online gambling. So you and I right now, we could go on to a Ontario gaming. So they white label it. So the background is
Mm.
Evolution Gaming, but Ontario Lottery Corporation or the BC Lottery Corporation or MGM will use Evolution to run live online craps tables or blackjack, or they've got these other games. They're coming out with games all the time, Monopoly, Crazy Time, et cetera, et cetera, et cetera. And we can play these games as if we were in a casino. We can communicate with the dealer. I can communicate with you. I'm not a gambler. But this is something that is taking from land-based casinos. People are now more comfortable doing this online. They have huge market share. They're clearly the market leader. They're founder-run, founder-owned, no debt. And so this is a business that we've also been recently adding to. It's about a 5% position to us. I've talked about them on BNN. And That's a
Are
good
they
one.
listed in the New York Stock Exchange as well as an ADR, or just
They do
in
it. Yeah, they
Sweden?
do have two ADRs. I mean, we own them
Okay.
in Stockholm. They would
Mm.
be one of the few foreign businesses that we own where you could own the ADR because there is enough liquidity there. But for the most part, we would encourage people to buy them
Yep.
directly on the foreign exchanges. Um, let's see here. So, I mean, the business that we recently bought, Activation Group in Hong Kong, I think I mentioned trading at around
Yep.
6 times earnings. We think that that's a high quality business. The founders have a significant stake in the business, a lot of cash on the balance sheet. Um, this is a business that doesn't really require a lot of capital to grow because they're just really a marketing engine for these luxury businesses in China. I mean, there's risk there, of course. How long is this Chinese malaise in terms of their economic challenges going to go on for? I mean, I think the Chinese consumer has really shown a propensity towards luxury. I think that either the number one or number two luxury consumers in the world, so we don't think that that goes away. But then, of course, there's all the caveats in terms of, when you own a Hong Kong listed company. I mean, Hong Kong is part of China. There's geopolitical risk there. We're not in the business of sort of quantifying or assessing geopolitical risk. The way we deal with geopolitical risk is to size positions accordingly. So I think I mentioned earlier that activation is a 1% position. I mean, if activation was in Norway available for 6 times earnings doing the business that they do, it would probably be a 5% position, right?
Mm.
So we do take that into account, and we have some guardrails in terms of our exposure to sort of areas where the geopolitics are spicy, shall we say. Um, there's an interesting business that we own in the States called Credit Acceptance. Their symbol is CACC. Um, I think on the surface, they look like they're trading at around 30 times earnings. By the way, Fever Tree also looks like they're expensive. But their earnings are recovering from the pandemic. So if you're investing in it and you're doing some research, I would encourage you to think about what a normalized earnings scenario looks like for Fever Tree. Same thing with credit acceptance. Credit acceptance is in the very unsexy business of subprime auto lending. Um, and there's some regulatory risk there. They are a buyback machine. So they've bought back something like, I think, 2/3 of their shares over the last 15, 20 years, run by very down to earth people out of Detroit. And so when they make a mistake predicting how their loans are going to do, they have to take some hits against their earnings, even though it's not necessarily a cash hit. So if they originally think that, let's say 70% of their loans are going to perform, but it comes in at 67 or 66%, they will take a non-cash hit against their earnings. But we believe that their cash earning power of that business is strong, probably in around the 500 million range. I think the business can be had today. So we always think about business in terms of like we're going to acquire the whole business. So we think about credit acceptance as I think it's a $5 billion or $5.5 billion business. We think the cash earning power of that business is 500 million. So, you're probably paying around 10 times, 11 times cash earnings. We think that's great value for a business that has shown the ability to generate returns in the sort of the 20% range over the long term. What's that? 4, 5.
Yeah. So we're on number 5. I know it's tough to round it out.
Well,
would
so-
Meta qualify for 2025?
I mean, so Meta's gone from the lows of, let's call it 100 to 600, and they're still only at, I think they're still under 30 times earnings.
Yeah.
So we've seen a 600% run here, and I don't even know if I could call the business expensive at these prices. I'll put it this way: it is more expensive than we would pay for it. So if we were looking to initiate a position in Meta, we would probably be wanting to pay certainly less than 25 times earnings, ideally around 20. I mean, when we bought it at 100, in retrospect, we were paying 5 times earnings for this business that was literally hiding in plain sight. There's another, I quote Munger a lot. There's another amazing quote by Munger that says, if you find a business that can return 18% on invested capital for the long term, if you pay an expensive price for that business or a cheap price for that business, your return is going to be strong if you hold it for those 10 or 20 years. I might put Meta in that type of category. The reason Meta is in an 8% position for us, as a 5% conviction level, is because it is technology. So I'm going to give you the caveat here. I mean, there was MySpace, and then Facebook completely wiped it out. Technology companies inherently are in the disruption business or being disrupted business, and that kind of scares us. But I mean, if you're looking at the Mag 7, Meta, I think, has the highest combination of sort of value, profitability. They're by far the most profitable of the big tech companies. I think their operating margins are something like 40%. I mean, really, it's a website, right? I mean, it's a beautiful business. They're essentially matching, they're allowing people to communicate and then using that platform as using the eyeballs as the platform.
Asset light, right? And highly scalable.
Totally. And so the game for Meta going forward isn't getting new users. It's increasing the ARPU per user. And so if you look at how much money Meta makes per Canadian or American user, and then you assume that could be possible for their European, Asian, Indian, et cetera, users, there's plenty of room for them to grow. The AI metaverse stuff, that is easily outside of our circle of competency. We have no idea who is really going to be. Really, only NVIDIA has kind of put up their hand as the company that has proven the ability to make money with AI up to this point. So we don't underwrite our thesis based on what Meta is doing with AI, but from what I understand and from what I can see, they have emerged as, maybe surprisingly or unsurprisingly, I don't know, but they've emerged as one of the leaders. And I think if anybody is going to be able to monetize and use AI in their business effectively, I think Meta stands a really good chance. But that's not why that's not why we bought them in the first place. We bought them because they are the dominant social media player. The other thing that's really interesting about Meta, and it comes back to why we favor founder-run, founder-owned companies. When people were throwing darts at Zuckerberg in 2022 for taking this big swing on this metaverse that nobody really understood, what few people understood at the time is, number one, Meta was generating about $40 billion in free cash flow, and he was wasting $10 billion on this. He wasn't borrowing, he wasn't issuing shares. If he was wrong, it's a lot easier to turn off an expense than it is to create a new revenue or profit stream. So that's number one. Number two, can you imagine Tim Cook, or some of these leaders of the big tech companies that aren't founders, that aren't big owners of the company, going to the board and saying, hey, I think the next thing is going to be the metaverse. And they're all going to look at you cross-eyed, like you're speaking Japanese. Like, what's the metaverse? Oh, and I want to spend $10 billion a year on this. There's no way anybody would say, yeah, sure, go ahead and do it. One of the benefits of founders and the way that founders think and behave is that they can think long term. Whether Mark is right or wrong, I don't know. But the fact, and he said this in some of his interviews, and if you read some of the transcripts of the calls, he said, listen, I am going to leverage the fact that I have the voting power of this business, and I can do some things that in the short term may raise some eyebrows, but I'm doing it because I'm thinking, what is Meta going to look like in 5 years, 10 years, 20 years down the road? And whether he's right or wrong, it's exactly the type of behavior that we want to be seeing from the people that we choose to partner our client capital with. So, yeah, I think Meta will continue to generate strong returns on invested capital. I think they will continue to dominate social media. I think maybe the way we communicate will change in the future, but I think that Meta will be a strong force, for many years to come, and that's why they're our number two holding.
And then hypothetically, Jason, if you were to short a company starting Jan 2nd, 2025.
MicroStrategy.
I love
That's
it.
that's an easy answer. And we owned MicroStrategy at one point, and it's gone up 20-fold since we sold it. The main reason is because that's starting to look like a massive Ponzi scheme to me. So where you're borrowing to buy Bitcoin, and you're issuing convertible debt to buy Bitcoin and more Bitcoin and more Bitcoin and more Bitcoin. I mean, at some point you're either going to corner the market. But I think, I read something recently that I think MicroStrategy's market cap is like 100 billion, but they own $40 billion of Bitcoin. So that's $60 billion of air there. I mean, maybe Bitcoin goes up 250% to fill that air. But it itself is air. So I don't know. I mean, we don't short, but you would want to short something that is, appearing on page one, or, is most talked about on Reddit, and I imagine it's MicroStrategy at this time.
And so what did you originally own MicroStrategy?
Well, we used to care about sort of macroeconomics and these sorts of things. And I'll admit to being heavily scarred coming through 2008. And I didn't want to experience another sort of a 50% drawdown. And the mistake I made was that I assumed that high quality businesses and the market were one and the same. So we used to actually have this downside protection where if equities went below a certain price, we would sell half or 100%, which is completely the opposite type of behavior that you should be doing with high quality businesses. As I just mentioned, 45 minutes ago, when something that is high quality that we like and that the thesis is still there for us goes down 50%, you want to buy, not sell. Mm-hmm. So, we've made mistakes in the past. And I don't know if I would necessarily consider MicroStrategy a mistake because we made 10x on our investment. But the thesis was that I thought that it was appropriate to have some exposure to Bitcoin. But in managing the money that we could, the way that we could, so we're managing model portfolios. So we have 3 models and all of our clients are in one or a combination of those models. I couldn't buy Bitcoin for them. I could have bought the Grayscale Trust or whatever, but we've got clients that are putting money in, taking money out. I couldn't buy, a fraction of a Bitcoin and then sell 0.01% because they wanted to go buy a car or what have you. And so I started to become curious and hunt, and I found MicroStrategy, which was a business that was an operating business. I believe at the time it was about $1 billion business generating something like, I believe it was $50 to $100 million a year in free cash flow. And Michael Saylor, they had $500 million of cash on the balance sheet, and he took that money and went and bought Bitcoin. And I was like, okay, I can make sense of this. Here's a business. The business is, let's say, moderate quality, founder run, founder owned, no debt, and it will be a way for us to gain exposure to Bitcoin. And if Bitcoin goes to zero, we still have this operating business. So I thought that the upside downside relationship was appealing. The thing immediately goes up like 10x on us. And then he starts borrowing to buy Bitcoin. And I was just like, no, 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 this isn't what I signed
Yeah.
up for. I signed up for your technology company with the understanding that any cash on the balance sheet and any free cash flow produced by the company would be used to buy Bitcoin. I didn't sign up for, wow, we're so smart. We've done an amazing job. We're now going to start issuing 5, 10, $15 billion convertible debt or whatever to buy Bitcoin. And so we were out. It's gone up 20-fold since then. I don't know how this all ends, but
Yeah.
it's probably not going to end well. And again, I was actually fishing with my dad yesterday, and he was asking about MicroStrategy, and I was, it's just what we did with MicroStrategy versus what we do on a day in and day out basis, looking for high quality businesses and waiting for them to trade at prices that make sense to us. That behavior is repeatable and scalable. What I did with MicroStrategy was just, it was a one off. I can't replicate that type of thought process in a consistent manner, where I would feel comfortable putting client capital in front of. So that was the
Absolutely.
story there.
We'll have to check back at the end of 2025, right, to see how that hypothetical short
Right.
worked out.
Yeah.
So, have you looked into Gen AI? I know you love data, you love tech, you've got your own proprietary app where you track and you cycle through different watch
Mhm.
list ideas.
Mhm.
Um, how do you think Gen AI might help you in the future?
So we've thought about this, and Stephen and I will occasionally go on to Chat GPI or some sort of AI platform, and we'll ask it. Like for example, there was a CEO change at Paycom, and not that long ago there was so the founder brought on a co-CEO, and so they were co-managing the business together, and this was somebody that had been involved with Paycom for quite some time. And then 3 months after this announcement, he's gone. Family reasons, of course. But I'm like, what happened here, right? And so, and I've like when these sorts of things happen, Stephen and I are relentless. Like we will search, like no rock left unturned. We will go to Reddit. We will go wherever we can to find the scuttlebutt, and we couldn't find anything. Like Paycom did a masterful job of sticking with the story. And it may well be that it was for personal reasons. We don't know. But it reeked of something more, right?
Hmm.
And so we put it into Chat GPI. I think the guy's name was Chris. Why did Chris leave Paycom? And the result was just, damn, it was very generic, very
Yeah.
ho hum. We've done this a few times. We're like, um, show me a high quality founder run business with high margins and no debt, that has put up returns on invested capital greater than 20% for 5 years in a row. And it's just not quite there yet. I think that AI could help us on screening. I think AI could help us on, so when we get an idea, Stephen and I, our objective is to kill the idea ASAP, because there's only two of us. There's 100,000 publicly traded companies on the planet. We want to be spending our time as efficiently as possible. And if we're spending a long time on ideas that we eventually kill, that means that we don't have the time to spend on perhaps higher quality ideas. So I think that it could help us kill ideas quicker. So for example, I imagine, and I think this already exists, but we haven't really looked into this. I feel like I could put into a machine learning program all of the filings or annual reports of a company, and I say, okay, I'm looking for CEOs that blame the weather, or I'm looking for words like return on capital or hurdle rates. These sorts of things would get us excited, or a lot of talk about culture, or a lot of talk about customer centric focus. Um, so I feel like it could help there. But where I don't think it can help, and maybe I have a bias here, where I selfishly think that I will still have a job in 5 years or 20 years, is the calls that we do with management and with investor relations people and the relationships that we have built with founders of the businesses that we run, where we can, email them, or we see a quarterly report come out, we can fire them a quick email, they'll get back to us. The old school relationship building. I mean, heck, like you and I mean, the way that we've met and the fact that we've kept in touch over the years,
Yep.
like the machine learning can't replace this, right? And so I I I I like to think slash hope that our ability to understand and judge culture, which if you think about it at the very, very fundamental level, businesses that we own are run by people. And if you have, like we do, if you think in terms of 10 years, 20 years, 30 years down the road, it's not the product that we're really investing in. We're investing in the people. And again, coming back to Mark Leonard or Warren Buffett or these really high quality sort of grounded leaders, I just don't know if AI can do that for us. And so
Yep.
I like to think that that's where we will still be able to have an edge and where our hard work will continue to be rewarded. But I do think that there is room for it to help in sort of like I said, the killing of ideas. I think we could maybe become a little bit more efficient as a result of AI there.
It's funny but true how many CEOs blame results on bad weather.
Oh, I know. So we have this program called Trello, which is project management software. I mean, I've literally got it on the screen next to me here, and it's kind of in anticipation of maybe this machine learning. We have two lists. We have the sexy word list, and then we have the yucky word list. And blaming the weather is firmly in the yucky weather list. Well, so Fever Tree, speaking
Yep.
of which, Fever Tree's recently blamed the bad weather in the summer in the UK for their recent results, and that sticks our antennas up. We're like, ugh. But maybe, if British weather, maybe it's not a big stretch for them to blame them, and it's only once, but it is something that both Stephen and I looked at, and we're like, ooh, we don't like
And
that.
tell me about other red flags. As soon as you hear those terms come up, you think, okay, what's the CEO up to here?
M&A.
Okay.
M&A red flag for sure, because and M&A in the absence of financial parameters or hurdle rates. So basically, they're saying we're going to deploy capital because of synergies or because we need to set up a new pillar or because we simply have the cash, we have to do something with it. That makes us nervous.
It's not a good sign because there's no vision, right, backing that statement, right?
Yeah. Okay. So okay. Oh, here's a good one.
Yeah.
Adjusted EBITDA.
Oh no. So
So,
why is
so
that bad,
Charlie Munger,
Jason? Tell
Charlie
us.
Munger says whenever you see the words EBITDA, you just replace it with bullshit earnings, right? So, or Warren Buffett calls it earnings before bad things.
Yeah.
So adjusted EBITDA. I've got my list here. Stock-based compensation. And that we should not include that in our analysis of cash earnings. That we don't like that. Um, a lot of talk about consultancies and
Mm,
outsourcing. Ooh, we really don't like that. We really like businesses where they are vertically integrated and they've built everything themselves. There's a business that we own called Keru, which is a fleet management software company out of South Africa, but they're based in Singapore. And we asked them, there's many companies like this across the world. What's your edge? What's your advantage? And they're like, most of our competitors will buy a little bit from this company. They'll essentially assemble a product with various service providers. Keru has done it all on their own. They've built the product themselves. If there's something wrong with it, they know how to fix it. They can do it quickly. If there's customer feedback, they can make tweaks because they've built the product themselves. Outsourcing, a company that outsources a lot of stuff, makes us scared. So here, weather, we talked about that. Connected transactions,
oh,
that we find that a lot in Asia, where the founder, the business might rent from a property that the founder owns. So you want to sort of question whether that's reasonable or appropriate. Um, Diversification. So we almost always substitute that with the word diversification. We see this a
yeah.
lot in Japan. We find that the best sort of creators of shareholder value are businesses that are very, very focused. They know what they're good at. They stay in their lane to the extent that they generate excess capital. I mean, our first choice obviously is please reinvest it back in your business at a high rate of return. If that's not possible, pay us a dividend. Or if your share price is reasonably priced or undervalued, buy back the shares. Don't say, well, we've done really great at, I don't know, making dog bowls. And, we were so successful. We've got all this cash flow that's now sitting on our balance sheet. We're going to go into the car rental business because we don't know if making dog bowls is going to be a great business in 10 years. So we need to diversify that. And that speaks to mergers and acquisitions, right? Many businesses will diversify by doing acquisitions as opposed to building themselves.
Mm-hmm.
So these are some of the things that frighten us.
That's so interesting, right? So Trello is a tab you have open
Yeah.
on your computer right now.
Mhm.
I'm always curious to know, investors like yourself, where you get your information. What other tabs do you have open right now on the computer?
Um, well, of course, I've got Excel. So Stephen and
Yeah,
I live at the corner of Excel and Trello.
yeah.
Um, we've mentioned Guru Focus. So you can spend $40,000 a year for a Bloomberg subscription, our only subscription. And this again, I mean, so the way that I've built, and this is well beyond the conversation today, but we could talk about Hillside and how we think and behave at Hillside at a future date. But we we have observed that the very best businesses in the world care deeply about their customers. So they're always thinking about how can I pleasantly surprise or please the customers. So we have incorporated that in Hillside. Talking about outsourcing, so we don't talk to analysts. We don't read any. We do all of our own work. So we don't outsource much stuff. So Guru Focus is our only subscription. It's $2,000 a year. It is very unsexy. It is just financial data. And they have data on publicly traded companies across the world. I always have that open. We also have SIA Charts is essentially the company that we use to help track our performance. So I'll usually have that open, which will help me understand how our models are doing in relation to our benchmarks and what have you. I've got books on my desk here, The Happiness Advantage,
Mm-hmm.
Positive Intelligence, The World Right Side Up by Chris Meyer. I've got this is kind of funny. This is a book. So we owned an HR business in Russia called Headhunter, and this was the book that the CEO founder wrote. We don't own the business
Oh,
anymore. Investing in Russia, that's probably a whole nother show for us. But I used the Google Images to translate this, so it's a book that I'm also reading. So I mean, Stephen and I read a lot.
yeah.
Old school books are great. Um, so yeah, and then yeah, Trello is a really interesting piece of software. So we use this software to essentially track. So it's project management software. So you can imagine if you had a project, like, let's say you were a construction company, you had a bunch of projects.
Mm-hmm.
Same with us, except for we're not a construction company, but we have
Yeah.
the companies we own in our portfolio is one flight. We have our investable universe, which is businesses that we've deemed to be high quality that are close to
Mm-hmm.
prices. So something that we've got sorry, that's our high focus flight. Our investable universe flight are businesses that we've put the high quality stamp on, but they're nowhere near attractively priced enough to us. We've got the pipeline, so those are businesses that we're actively working on. And then we've got the non-interested, which is the businesses that we've looked at that we've passed on. So we put those in there. We don't ever really get rid of them ultimately. And then within each card, we have, I don't know, maybe 100 fields. Are they ROIC focused? What does the competitive landscape look like? How much do the founders own? How are the founders compensated? What is our estimate of cash earnings? What is our estimate of fair value estimate? And then Stephen can put notes in. I can put notes in. We'll put notes in from our calls, from any of the quarterly reports that come out, and he can see what I've been working on, and I can see what he sees. So it's a really wonderful tool, and we've kind of adopted it to essentially our workflow. It's been invaluable for us.
That's a great way of managing ideas. So
Mhm.
before we close out, last question. And it cannot be Warren Buffett, the answer,
Okay.
unfortunately. It would be too easy. Pick one investor, alive or dead, who if you could have coffee with, you would choose them, hands down.
So Charlie Munger. I
Okay.
assume if you say it can't be Warren
Charlie
Buffett,
works.
it does work. That hands,
Charlie
and
works.
in fact, I would pick Charlie over Warren, only because
Most people wouldn't though, right? So why? Why
because
Charlie?
because so I went to the Berkshire AGM in 2018, and up until then, I didn't know much about Charlie Munger. I just knew that he was Warren Buffett's, right hand man. They'd been friends and business acquaintances for 60 years. During the 6 hours that is their AGM, Warren spoke 98% of the time, and Charlie spoke 2% of the time. Charlie received 95% of the laughs, and Warren received 5% of the laughs. I've never met anybody who had the ability to say no more than what was needed, but enough to literally. So this is in like a stadium, a 20,000 person stadium, to literally capture the imagination and minds of the 20,000 people in there. And he was 94 or whatever at the time. I was just in awe of him. And so since then, I've read a lot about Charlie Munger, and it's just an amazing life that he led, just an amazing person. He had experienced horrible hardship. He lost a child. I believe he
Yep.
lost sight in one of his eyes. I mean, he's had a tough life, and he grew up during the Depression, right? I mean, he's seen and seen it all, and just his ability to explain human nature, human wants and desires in such a succinct way, and in such a sort of such a rational. The rationality of that man is spellbinding. Like it's just amazing. And then if you dig a little bit deeper, so when Warren Buffett started his partnership, he was doing what he called cigar butt investing, right? Which was
Yep.
the Ben Graham intelligent investor. I want to buy a dollar for 10 cents or 20 cents. And when it gets close to a dollar, I'll sell that dollar. Munger came in and that works. That worked from, let's say, 10 million to a billion or something. Munger had the wherewithal to come in and say, no, Warren, let's focus on buying great businesses at fair prices. And their first foray into that effort was See's Candy, which they
Yep.
bought in 1970 for, I want to say, $20 million. And at the time, Warren was like, oh my God, I cannot believe we are paying, I think they paid like 12, 15 times earnings for See's Candy. That $20 million investment, they have extracted $2 billion of free cash flow out of that
It's
business. So
amazing.
here's an asset light business
Yep.
that had pricing power, didn't require much capital to grow. I think they've invested $40 million in that business since the 70s and extracted 2 billion. But it's not just the 2 billion, because then they've taken that 2 billion and turned it into Geico and Coca-Cola and whatever. So that $20 million investment, which Warren Buffett would never have even looked at but for the insistence of Charlie Munger, has really had a massive impact, not only in terms of how the two of them think and behave, but in terms of the results of Berkshire Hathaway. And Charlie, like what Buffett's net worth is 100 billion. I think when Charlie died, his net worth was 2 billion. It was never about the money. It was never about being right. He didn't need the accolades. He didn't need to be on CNBC. He didn't need any of it. He just needed to live a life that he was proud of and that his family was proud of, and to have an impact. So hands down, he would be somebody that, and unfortunately, he's passed on. But yeah, I hold him, and not just as an allocator of capital, but as a human being in the highest
Yep.
regard.
And people who are watching this video, they should go out and the local library pick up Poor Charlie's Almanac. I think that's
Yep,
a fantastic book to read.
yep. So that's next
Could
to
during that
that's on my bedside table at home.
Awesome.
Yeah.
During that coffee chat though, Jason, would Charlie convince you into buying Costco stock? Could he?
uh, at 50 times earnings.
That's why I ask, right?
Yeah, no,
No?
I don't think he would try. I think what Charlie would say is go out and find the next opportunity like this.
Hmm.
Um, I mean, if you think about it, really, Constellation, buying Constellation software at whatever 10 to 15 times earnings or whatever they were trading at in 2014. Um, you know, so Stephen and I talk about triple baggers, or no, sorry, um, triple dip. So opportunities where you get the opportunity for earnings growth, high returns and consistent returns on capital, and multiple expansion.
Mm.
So you buy Costco today, you might do okay if you hold it for 20 or 30 years, but it's very possible that Costco shares go nowhere for 5 years, while the earnings might continue to increase, but the multiple goes from 50 to 40 to 30. What you'd really rather do is find the next Costco, the next Constellation, where you have the visibility that the returns on invested capital will be greater than 20%, let's say. Let's say they're going to continue to grow. Like my perfect stock scenario, you find a business with the ability to predictably and consistently return, let's say 20% on invested capital, grow their earnings at around 15%, and you can buy it at less than 10 times earnings. You run the math on that over 10 years, and you have a 10 bagger on your hands. Um,
I love
Now,
that concept, that the triple dip,
yeah,
and you want to check off all three,
yeah,
right?
yeah, yeah.
For the maximum outperformance. This has been a lot of fun, Jason. Thanks again for sitting down and having this conversation with us. Thank you.
My pleasure. Thanks for having me. Take care, Robin.